Now let's get you set up for Delta results with our next guest, Jefferies Aerospace and Defense Analyst Sheila Kahyaoglu. Sheila, it's great to have you back on. Let's start right there. How does Delta set the stage for airline earnings and broader industrials?
Sure. So what we're looking for with Delta is flat price in the third quarter from down 2% in the first half. So we're looking for an economic improvement on pricing and scheduled capacity cuts coming into the second half of this year and improving into 2026. So we'll see if we get that. That'll be driven by corporate coming back, mainline improving a little bit, and of course the premium passengers.
Sheila, should investors ignore the shutdown's potential impact on airlines, even though it's still dragging on?
For the most part, across our coverage, whether it's aerospace, defense, you could largely ignore it. On the airlines, it'll have some hit. As an example, in 2018, 2019, it was a 1% to 2% hit for Southwest and United, which are the most government exposed, not so much for Delta.
Is Delta, if you had to choose one going into the earnings season, is it Delta or is it something else?
We have buys on Delta and United, where our estimates are 10% above the street. We're 10% below on Air Canada and American as an example. So those are our two favorites into the quarter. Delta already revised upwards slightly in mid-September, revising up their revenue guidance from the low end to the high end, but also said their costs were higher because of weather-related costs. We like Delta. We think it's going to be a bellwether. We'll see if they could print flat pricing, which would be the signal of improvement we're expecting in the market for the second half and going into next year, especially given airlines are still trading at a 50% discount to the market. So they could regain some multiple momentum as well as EPS growth.
What are your favorite of your defense-connected names with the markets here at highs?
The large caps have largely underperformed. Looking at Lockheed, it's been the worst performer year to date. LHX has been one of the better primes. Where has worked has been small caps. To Stephen's credit, Kratos, AeroVironment, stocks like that have really run up 100%, 200% this year. So we actually really need to see the budget move forward. Contracts like Golden Dome, the Navy fighter actually get awarded because some of these stocks are running on it, the small caps especially. Our favorite name is LHX and an IT services provider named Leidos.
Yeah, and of course there's now a possibility that we get that down select for that Navy next-gen fighter maybe as soon as this week, according to reports. We'll have to see. I'll ask about the aerospace side too. I mean, with all the airlines cutting capacity, can they get enough of the future planes that they've ordered, and is the supply chain primed for it?
This is the most popular question we get, Morgan, so thanks for asking it. If you get a plane, do you retire an old one? Does it mean you go long Boeing and short GE? Not necessarily. We think both could work. Boeing and GE have been two of our favorite names. GE has had a great run. Boeing, we think, is going to announce some charges in the quarter, $4 billion of non-cash charges, $2 billion of cash push out for next year. So we're below the street by 20% on that one for next year's cash on the 777X being moved down. But supply chain is actually working. 737s on a roll from 24 a month produced last year. We're in the mid-30s this year, going up to 42 next year. So we think they could keep that cadence. 787 is also doing well. They started out the year only producing 5 a month. Now they're at 7 a month, going to 8 a month. So productivity is actually working with Boeing for the first time. They're having some development program delays just given the FAA. So we'll see what happens there.